All right. Good afternoon, everyone. Welcome to our weekly Wednesday workshop at 1 p.m. with New View Trust Company. My name is Brian Martinez, and today I am really happy to bring on our guest speaker, Dave Stech. Today he'll be covering the State of the Union for real estate investors and entrepreneurs. He's got a lot of great information. He's great at timing the market. But before we get started, just a few things. New View does not provide any tax or legal advice. You want to consult before you make any investments with your CPA, financial advisor, tax advisor, whoever you need to consult with. What we do is we custody your IRAs, your education savings accounts, health savings accounts, solo 401ks, where you can hold alternative assets. If you're new to New View and self-directed IRAs, well, a self-directed IRA, it's really just a marketing term. It gives you the ability to hold things outside of the stock market. So unlike a Fidelity or Charles Schwab that limit you to stocks, bonds, mutual funds, New View gives you the self-direction ability, true self-direction, to diversify your portfolio into alternative asset space and things that you might already be doing. Things like investing in real estate, doing private lending, mortgage notes, tax liens, cryptocurrency. So you're investing in what you know best. And there's also some tax savings that comes along with that. If it's a Roth IRA, it's going to grow tax exempt and you can take it out tax free when you're ready. There's no required minimum distributions for a Roth IRA. Something like a traditional IRA, well, that's going to grow tax deferred and you don't pay taxes until you're at retirement, which you might be at your lowest tax bracket at that point because you're no longer working. So you have to discuss that with your CPA and figure out what plans work best for you. So these are your personal plans. You have your traditional IRA and Roth IRA. If you are self-employed or an entrepreneur, you might want to look at these employer plans. So the solo 401k has high contribution limits of $61,000 a year. You can also take a loan against a 401k if you ever needed to borrow it. A personal loan of up to $50,000 just cannot exceed that 50% of the total value of your account. Then you have your SEP IRAs, also a great employer plan. If you are self-employed and you might have some employees, you can contribute up to 25% of your self-employed or earned income at the maximum amount contributed of $61,000. And then your employees, whatever the contribution you made to your SEP IRA, you must do that same percentage of contribution to their SEP IRAs. That gives them the ability to invest in these alternative assets alongside with you as well. And then you have a simple IRA, great for small businesses. The maximum contribution is $14,000 for that plan. And it has a mandatory 3% match for employees that are eligible. There's a $3,000 catch-up contribution if you're over the age of 50. Then you have your specialty plans. You have an education savings account. It's $2,000 a year that can be contributed. This is specifically for your kids, your grandkids, and it's a college savings account. Health savings account. If you have a high deductible health care plan, you can open a health savings account and you can make contributions to that plan. And that can also be self-directed into alternative assets. Cool thing about the health savings account, it's tax deductible going in and tax-free coming out for medical expenses only. But you can keep that money invested and growing as long as you like. So I covered a few of the most common asset types earlier, but these are the most common types of assets we see our clients investing in. So private entities is pretty general. It could be a syndication, joint venture, LLC, any startup company, something that might be pre-IPO. Then you have your real estate, and that's pretty general as well. There's a lot of things in real estate you can invest in. Could be commercial, could be offshore real estate, buy and holds, short-term rentals, land, mobile home parks, self-storage, tax liens. So there's a lot you can do in real estate. Then you can do private lending. You have your promissory notes, secured or unsecured. So there is a difference. Either it's secured by something that's tangible, an asset like piece of real estate, where the borrower must pay you back just like a bank would, because you're loaning them money with some interest or whatever the terms of that note are. Or it could be unsecured, where it's not secured by anything, but you can charge higher interest rates. And then some clients like to diversify their portfolio into cryptocurrency as well. So these are some of the most common types of assets we see our clients investing in. All right, so I'm gonna go ahead and turn it over to Dave Stech. He's got a lot of great information for you all. Thank you all for joining again. Dave, welcome.
Brian, how you doing?
I'm doing wonderful. How are you?
I could not be better. I'm here with you and with a number of people who want to listen to what's going on in the market. So
Yes, sir.
always love to hear that. Um, can you see and hear me okay?
We can see you and we are sharing your screen. We can see everything perfectly. So we're going to go ahead and turn it over to you and I'll join you back at the end for Q&A.
Sounds like a plan. Well, welcome to the 2022 and soon to be 2023 State of the Union for real estate investors. And I'm going to cover the economic and housing market update. And for those of you who aren't aware, I've been doing this since 2005 at Harvard when I presented my facts and figures that led me to conclude that the market was going to implode. And that was in March of 2005. And I pretty much got thrown out of that room because at that time the market was on fire and no one believed what I thought was coming next. I picked the next market, Las Vegas. After that, I picked the bottom of the market in January of 2012. And I picked the most recent activities that have been happening about 6 months ago. So I'm going to share that State of the Union. It's going to be updated literally through 9 days ago. So this is as current as it gets. Now, the usual disclaimer applies. There's not going to be anything solicited or sold. My goal today is simply to update you on the current economic and housing market as I see it, so you can be better informed and make better choices as an investor. Well, I also like to start by thanking the folks who bring us together. And who are they? Well, you know them: Jason DeBono, Grace Nelson, Brian Martinez, and most recently, Maggie. They've asked me to share my new 2022-23 State of the Union for real estate investors with you. And I want you to know that there's not been a more important update in the last 11 years. And you're probably already feeling that there's a lot of uncertainty and a lot of softness that's going on in real estate right now. Well, as we only have an hour today, I've had to squash what was a 3 hour presentation totaling 365 slides that I did to our insiders last week way down. And so I'm going to be moving really quick, but I'd like you to be able to look at this as a replay later and drill down, look at charts, look at graphs, and really try to help understand what I've shared with you today. So with that, let's get started. Now, let me start with a question for you as an investor. And this is a really important one. It really kind of goes something like this. I'm about to read 9 words to you, and I want you to write down the one word that best describes how you as an investor are feeling today. Are you feeling, in alphabetical order, denial? Are you feeling depression? What about despondency? What about euphoria? Are you excited? Are you fearful? Are you hopeful, or are you optimistic? Maybe you're even panicking at this point. Now go ahead and type your one word that best describes how you as an investor are feeling today in the chat box. And I really want you to be honest, and I'll explain why in just a second. Okay? Well, you see, every market cycle has a life cycle of investor sentiment over time. It's really the nature of cycles, and boy, has it been shifting as of late. The point of maximum risk in an investment is at the euphoric stage. And the opportunity, that is the maximum opportunity for an investment, is at the point between despondency and depression. And that point is called capitulation. So the question is, where are we in this market cycle? Well, I know how I feel, but it's not up to me to tell you how I feel. It's more up to you to tell me how you feel, because unlike opinions where we can both have different ones, feelings are our own. And you're probably feeling somewhere on this continuum as I type. Well, it turns out if we look at the economic update, it tells us a lot of important information to help us inform our decision making. For starters, we always start by using the best partners that we can, the best data, the best sources that we can find for being able to determine what's coming next, and then to pull all that data together into a report like this. So today's economic update is largely going to address four things that I get the absolute most questions about. Number one, what's going on in the labor market? What's number two, what's happening with interest rates and about to happen? Number three, where is inflation heading? And number four, are we in a recession? And if not, when's it coming? Well, I'll start by talking about the Fed because they've got a dual mandate. And that dual mandate is A, to maintain a heavy level of inflation, which is really in the form of price stability, where prices aren't going up too fast or going down in terms of devaluation. And number two, to keep maximum employment where it needs to be to support that healthy inflation. And the two are intimately connected. And it's very much a balancing act. And the Fed hasn't done very well in balancing it. We did add 315,000 new jobs in August after 528,000 in July. So we've now regained all of the 22 million jobs lost at the height of COVID. So at the end of the day, this annual rate of 6 million new jobs is 3 times faster than we historically see in a good year. But headline unemployment actually went up to 3.7%. Not a big increase, but an increase nevertheless. And if you add in those that are underdeployed, or I should say underemployed or discouraged, it's more like 7%. But headline unemployment is what the Fed uses, and they continue to want at least a 4% maximum employment target. So we're below that. So they're going to have to do something to create more unemployment. Think about that. And you ask yourself, well, how can we add jobs but unemployment goes up? Well, simple. It's an increase in the labor force participation rate. And that rate has been steadily falling for the past 20 years from 66.6% to 62.4%. Well, it turns out that it increased a little bit in August, which added more workers to the total labor force, the labor force participation rate. What's interesting is that Americans are now holding 2 full-time jobs more than at any time in the last 30 years. Well, to me, that's a sign of economic weakness if people have to have 2 jobs just to keep up. And what that's doing is effectively propping up the job market. That's what inflation is doing. It's creating more opportunities and therefore propping up the job market. But then there's, on the other hand, this new form of quitting that's increased in the workplace called quiet quitting. And it's really big. And it's increased a lot most recently by social media. Quiet quitters aren't walking away from their jobs. They're renouncing this notion of a hustle culture where you have to work hard to get ahead. And the idea of going above and beyond at work is not something they embrace. A recent TikTok user coined that phrase of quiet quitting, and 3 million views helped popularize the movement. Well, that trend is resonating strongly with Gen Z and millennial knowledge workers fighting to rewrite the rules of the marketplace and in the workplace. And that's been problematic for those of us employers. Well, employees must be sensing a shift in the job market because now 21% of American workers are worried about losing their job in the next 12 months, compared to half that 4 months ago. And remember, when the Fed tries to solve for inflation, it almost always affects employment and vice versa. So an economy with a high rate of inflation like we have has to decrease prices. And the trade-off is we're going to increase the rate of unemployment in the process. So the Fed is trying to move us down what's called the Phillips Curve, which is something that I learned in grad school in economics. And it's not something we need to get into now. But what we're starting to see is this nominal wage growth from an increase to a flat, now a decline. And it's still up 5% year over year, but wages have been growing less rapidly than in the first quarter. and they'll continue to slow into the third quarter. And the picture changes when you use real hourly earnings, because while wages are going up, real hourly earnings are actually going down. They increased slightly month over month in August, but that's the reported drop in inflation. If inflation drops and wages stay the same, real hourly earnings go up. Well, now we're seeing layoffs, especially in aggressive growth sectors like disruptive technology, interest rate sensitive sectors like mortgages, where banks are laying off. How about companies that boomed during COVID lockdowns? Well, 4 of the 5 sectors responsible for the most layoffs have been cutting jobs at a greater clip this year than last year. In terms of the financial sector and the automotive sector, the technology sector, the healthcare sector, and even services. So for now, planned job cuts are at now a normal historic level of 20%. So while it's increased to 20%, that's what it's generally been historically, where employers plan job cuts. So it's definitely been rising, as you can see from the spike, and high labor costs are continuing to hurt small businesses, maybe like yours or mine, especially if you're in the leisure and hospitality industry. Meanwhile, income is rising faster than outlays, meaning that people are saving money or intentionally spending less. Those things are going to slow demand further. The more people save and the less they spend, the more it's going to slow economic demand. And both currently remain above pre-COVID trends, but they're dropping. The economy needs both of these to slow down in order to curb inflation. Well, 57% of households are tightening their budgets, and I mean really tightening them. And if you look at the Fed, as I always jokingly say, trust in the Fed because they know what they're doing. Just ask the head of the Fed, Jerome Powell, who said, "We now understand," this is 3 months ago, "we now understand better how little we understand about inflation." That is scary. Now, whether or not they know what they're doing, the Fed may be having some effect on inflation because inflation has eased over the past 2 months. Now, it's gone down from 9.1 to 8.6 to 8.3, but this is a minor victory because inflation is still 4 times the Fed target of 2%. And it's going to take more economic pain and take longer to get there than you think. We've been seeing this gloominess in the various consumer confidence indices, where expectations are still way below what the headline economic situation would exist or would suggest. So people are feeling gloomy. And that's often how it works. When things are going good, or at least okay, as some of the current economic fundamentals would suggest, people expect a turn for the worse at some point, and vice versa. And it's not like it's just the consumer surveys. There's plenty of evidence that's suggesting that our economy is slowing. If we take the ECRI, we can see that it's dropping considerably. And that's a pretty comprehensive index that includes a lot of things that we don't have time to get into today. And technically, we're already in a recession. You see, a recession is defined by 2 consecutive quarters of negative GDP. So we saw that there was a decrease in the first quarter and again in the second quarter. And that's the first time we've had a quote recession since the second quarter of 2020. Unless, of course, you want to redefine the term, which is what our administration is trying to do by saying, well, we're not really in a recession because all these other indicators are showing positive. Well, whether or not we're in a full-blown one or not is another question. But I can tell you this, by year end, there's a 94% probability that the Fed is going to increase their rates again. And it's going to likely start this week. Well, that's between a 1.5 and a 1.34 or a 1.75% increase in the current target rate of the Fed. So there's also a 60% chance that it could be higher. So remember, it was less than 0.1% for 2 years from March 2020 until March 20 of 22. Well, look at where we are now. Interest rates are going up. And the supply chain, meanwhile, is continuing to show signs of improvement. Now, I won't get into the global supply chain pressure index, but just know that it's fallen to less than 2 standard deviations. but it's got a long way to go. Consumers, meanwhile, continue to spend more on services than goods. You see, at the beginning of the pandemic, when services were shut down, people were spending more money on goods like Amazon. Well, that's shifted. And now all of a sudden, the Services Purchasing Managers Index is showing a significant increase. It's a reading above 50%. And anytime that happens, it suggests that there's a expansion of the services economy. So that's a positive sign for the supply chain, and it should mean less import volume and better gross domestic product moving forward. That said, while many continue to overorder goods, retailers are feeling the pain. Where Walmart is lowering their profit forecast, retailers are having liquidation warehouses basically offing their inventory for them. So that there's another recession indicator, the yield curve. And I don't have time to get into it in detail today. I just want you to know that there are points at which the spread goes negative, and that typically precedes a recession. Well, if you subtract where we are on the T bond, and I don't want to get into complicating things, I just want you to know that a recession has followed the last 7 times that what's happening today is happened. So we are in a situation where the yield curve today is turned negative. And whether you understand this or not, you need to know that when it goes negative, things don't go well. And that's generally preceding a recession. That's a pretty big deal. So, what does that mean to a professional investor? Well, I've already told you. The yield curve inversion is a sign that investors are betting on two things: continued rate hikes and economic uncertainty in the near term, and interest rates and inflation declining in the long term. In other words, a recession. So, economists, when asked, are unusually mixed. 50% think that a full blown recession is coming, and 50% think it's not. So, it's really a coin flip. But of course, as I've already shared, technically we're already in one because GDP has dropped in the last 2 consecutive quarters. How are the financial markets doing? Well, because as much as anything else, financial markets are a barometer on the real economy. They're a real time indication of people's attitudes about the strength of the economy as it changes day to day. And what we're seeing in the markets right now is a reflection of uncertainty. That's the key word right now about what's going on in the markets. And I'm not surprised because 9 months ago, on a webinar like this, I said that all the markets are overvalued. And if you're thinking about getting out of any market, this would be the time. Well, these are all factors that will ultimately have an effect on your business. So let's see how it's affecting businesses in the public markets. Well, the Dow is down nearly 16% year to date as of last week. The S&P is down over 19% as of last week. The S&P 500 and their price to earnings ratio has fallen below pre-COVID levels to 28.8. Now, it used to be much higher than that, and I believe that the market is still overvalued. So we're going to see continued corrections in the public markets. And you might say to yourself, well, what about real estate? It's been doing really well. Why are REITs down 13%, real estate investment trusts year to date? And why is it? It's because investors fear that rising interest rates are going to affect real estate, which causes the real estate investment trusts to outperform going forward, because we're trying to skate to where the puck is going, not where the puck is. Both base metals and precious metals have lost a ton of value. Gold down 16%, base metals down 33%. And that's rarely the case. Generally, when the economy is doing well, precious metals go up. But the opposite tends to be true when the economy is doing poorly, and both are falling right now. Home builder bond yields have risen 4% in the last year, while mortgage rates have risen 2.8%. What does that indicate? It indicates, and I want you to understand this, that mortgage rates could be well over 7% if the government didn't intervene. So where does that leave us in terms of the third quarter GDP forecasts? Well, they're in the plus 1 to 3% range. And my take is that we're going to see a stagflationary quarter in which inflation stays high and economic growth stays low. Now let's talk about the housing market. Now, as I go through this housing market update, I want you to keep 4 questions in mind. How important is affordability to the housing market? How quickly can a given market turn from bad to good or from good to bad? How important is timing in real estate investing? And how important is research like I'm sharing today in this market cycle if you're trying to inform investing decisions? I want you to think about those 4 questions as I go into this. Number one, home buyer sentiment remains incredibly low. It did tick up noticeably from July to August, where in August, the net share of consumers who say it's a good time to buy increased by 8 percentage points to negative 51%. So overall, home buyer sentiment is still very pessimistic. Now, the question is, do you share this pessimism? How are you feeling? Because feeling tends to inform your decision making. What about home buyer desire? And we measure this based on traffic. How many showings are happening in real estate? Well, that will lead to less demand when showings go down. And the average number of buyer showings on active residential properties on a monthly basis is dropping considerably. In July, it went down 17%. In the Western United States, showings are down by almost half. And it's not just the usual seasonal drop off. These are showings that are as low as they've been at any point in the last almost 2.5 years. They're on par with what we were seeing in November and December of 2020 when we were in a lockdown. So the current showing levels are roughly equivalent to peak season levels from 2017 through 2019, but that was 3 to 5 years ago. So demand is still elevated compared to pre-COVID, but boy, is it slowing. Market conditions have negatively impacted 68% of all home purchases. Well, pending sales are now down 22%. And pending sales are generally our best way to measure demand because pending sales are escrows. So remember, unless you're looking at pending sales as a percentage of all listings, you can't immediately tell whether a decline like this is a function of demand or supply, but I'm telling you, it's demand down. Median sale price is still up 6% year over year, but you can see the slope of the line going down in black. It's declining much more than it normally does at this time of year from a seasonal standpoint, so prices are going south. The actual number of homes sold is down 17% year over year. And remember, homes sold was demand 2 months ago. In other words, these have been in escrow for the last 2 months. So we're seeing slowness from 2 months ago just now. Total existing home sales, not new, are down 1.2 million homes. That is a 20% decline from July of last year and a 6% decline month over month. That's the 6th consecutive month of decline. And on an annualized basis, home sales are now noticeably lower than pre-pandemic levels. In terms of sentiment again, the net percent of consumers who say it's a good time to sell fell 16% in the last month. Right now, 59% think it's a good time to sell and 35% think it's a bad time to sell. Will that change? If it does, will that affect month supply? It has to. And indeed, it already is. After a huge increase in the second quarter, the number of new listings has plummeted in the third quarter. They're down 13%. And while sellers have been fueling the recent run of inventory growth, seller sentiment shifted greatly and will continue in August. Sellers may feel that they've missed the peak or that it's too difficult and expensive to buy another home, or maybe it's both. But one way or the other, active listings are what you really care about, and they're up 27% year over year. Very interesting. In other words, inventory is rising. So the competitive multi-bid offering thing is slowing considerably. Normally, this would be a result of adding new listings or drops in pending sales. But with new listings way down, it can only be a drop in pending sales. So while inventory is still increasing due to less demand, inventory growth has slowed due to fewer new listings. So there has been an offset. Well, if you look at weekly active listings, the more slowdown in inventory growth becomes more obvious. It's down 30% at the beginning of the year, and at the beginning of the year, and now it's up 29% at the beginning of July. So we're seeing inventory data that's been stuck in the 25 to 30% year over year range in growth for 8 weeks in a row now, which basically means there's a slowdown in inventory increases again, likely because there are less people listing their homes because they don't believe they'll sell them. Well, we track inventory milestones, and the two that have already happened are the seasonal bottom and inventory is up. What we're waiting to see is what inventory's like compared to 2 years ago, and what it's like compared to 2019. Well, compared to 2 years ago, it's down 5%. Compared to 2019, it's down 42%. So my expectation is that inventory is going to be up in October compared to 2020, and a key will be if inventory increases this month. Black Knight is a research firm, and they have a home price index. And what they show is that median home price actually declined month over month in July. And it wasn't much, just under 1%. But the fact that it's not going up and home price appreciation is going backward, that negative growth is striking because it's the first time in 32 months and it happened fast. Well, I forecasted it 9 months ago. I reforecasted it 6 and 3 months ago. And now, sure enough, we're seeing price growth declining in all regions since February. Fortunately, our insider community was aware of this. And these declines, as they knew would happen, are not uniform across all regions. Markets like Northern and Southern California have seen home price appreciation growth cut in half, where Florida and Southeast are generally declining much more gradually. 85% of major markets have seen prices come off their peaks through July. And the share of listings that are reducing price, or I should say the share of listings that have reduced price, is now 20%. So we saw a massive spike starting in May, taking us from 8% of listings that were reducing price to 20%. And that growth in price reductions has begun to level off. Why? Because it's possible that sellers are just overpricing, feeling entitled to get top dollar, despite being late to the game on listing and selling their homes. And there's probably some of that in this 19.4%, but more likely, I keep coming back to it, it's a function of moderating or declining demand. What about new home sales? Not just existing, but new home sales. They were down 29.6% year over year. On an annualized rate, that's 220,000 fewer homes sold. Year to date, new home sales are down 16% compared to last year. And as with existing homes, new home sales declines need to be considered in the context of supply or demand. Well, this drop in new home sales often precedes a recession. Starting in late 1973, it's rare for the rate of annual new home sales to drop below 600,000 without a recession in the offing. And we're sub 600,000 now. A lot different picture than what I said a year ago, right? But I warned you even a year ago and 9 months ago that it was coming. And one of the big reasons for the new home sales plunge now is the 18% cancellation rate, the highest in over 9 years, higher than April of 2020 when the pandemic happened. So buyers are clearly getting spooked. And in addition to the cancellations, builders are seeing much lower buyer traffic. In fact, traffic now is roughly comparable to what they saw in March and April of 2020 when things dried up during the pandemic. This rapid deterioration is being repeated on their earnings calls, and the whole tone of the industry is shifted to one of much greater caution. Based on the sales rate in July, new home months supply is now almost 11 months. Now, there are 3 stages of that. There are finished lots, there are those that are being constructed, and those that are being permitted. Well, that's up 9.2% or 9.2 months in June, nearly 2 months more supply in a single month. So in 1 month from May to June, we gained 2 months in equivalent inventory. And 11 months is roughly double the normal range. and not far from the peak that we saw during the global financial crisis in 2009. That said, to be fair, a lot of new homes will be completed later this year and in 2023. So the current estimate, if you look at multifamily, single family, and manufactured homes, is that we're going to see an increase of 10% this year to almost 1.6 million homes. And if unchanged, that would be the same level of completions as the global financial crisis after the peak in 2005 and 6. Well, most of that supply is still under construction. In terms of completed supply, it's low, 1.1 months. And that's about 2/3 of the normal level. But if you look at under construction, 7.3 months is a new record, and not yet built, that is permitted lots, are 2.5 months, which is more than double the normal level. So you hear all this nonsense about how we have this shortage and how we have this insatiable demand. The good news in all of this is that builder margins are such that they have plenty of room to reduce price and stay profitable. 28% builder gross margins are the highest I can remember. In fact, 42% of builders are now dropping their price and will still be profitable. Well, compare that to just 6 months ago when 92% of builders were raising prices. How quickly it can change. Public builders have increased their lot count 20% year over year. And you might ask, well, why would they do that with what I just shared? Because what do builders do? They build, and they're positioning themselves for what they hope to be a lot of growth. So it's going to be very interesting to see what happens, because single family permits have dropped 5% year over year. So what are builders going to do with all that land? Well, builders are not locked into actually buying it. They've got it held, in effect, controlling the inventory, not buying the inventory. And they have the option to renegotiate or walk away from 62% of the land they control. Well, according to the National Association of Home Builders, we are officially in negative outlook territory. And that's the home builders themselves saying this, not me. This marks the index's 8th straight month of decline. And look at the rate of decline you see on the far right. Well, that is highly correlated with single family starts. And with those starts in sharp decline, sentiment has gone bearish quickly. Remember how everyone was bragging about how great the market was even 3 months ago? Well, now home builders are saying that we're in a housing recession as of only 4 weeks ago. There are 3 components that they look at: current sales conditions, which dropped, sales expectations, which dropped, and buyer traffic, which dropped. So home builders are increasingly pivoting to the build for rent business instead of sell to retail clients business. And they're also selling their standing retail inventory to rental investors, in many cases at a discount now. More rental supply is going to put downward pressure on rents. And risk is everywhere. Again, I'm not trying to be the harbinger of bad news. This is all backed by facts. And I'm showing you the result of all the facts and all the data. I don't right now have any investments in real estate. We've pivoted completely to private lending. Why? Because risk is everywhere. Nearly 3/4 of major markets are high or very high risk. The only markets in the low or very low categories are urban growth markets, which is actually a reversal of what we were seeing 2 years ago when the outmigration was happening. At 36%, the current payment to income ratio. So a payment is 36% of income nationally, and it's over 50% and almost 60% in California. That is 2 points higher than the bubble peak, and now it's at 36%. According to this metric, housing affordability is at its worst point since the early to mid 1980s. So just imagine the impact of a further increase in interest rates on this. And as you've heard me say before, the higher the payment to income ratio goes, the more affordability becomes a serious problem. So during this particular cycle, home price appreciation has significantly outpaced income growth, which is driving the housing paying to income ratio higher. I don't expect it to increase much further, if at all. It's time for it to turn, because the mortgage market seems to be renewing its perception of a more aggressive monetary policy. The increase in mortgage rates is coming at a particularly vulnerable time for the housing market. Sellers are really actually recalibrating their pricing due to lower purchase demand, which is likely resulting in continued price growth deceleration or declines. Mortgage rates of 6%, and it recently just hit 6.12%, will be a hurdle for 85% of home purchasers. In other words, they can't afford the payment. And as we talked about in the economic section, there are reasons to think that the 30-year rates could actually get over 7% unless the government intervenes. But remember, the government is controlling through the Fed the increase now to cool the economy, to reduce inflation, to increase unemployment. And mortgage purchase applications have done nothing but fall since January. And they fell another 1% week over week in late August, taking them down 21% year over year. The purchase index is now only 11% above the lowest point we saw during the pandemic. Refi applications are even worse. In late August, they dropped 3% week over week and now sit as low as they have been in 21 years. What about foreclosure activity? Well, it does continue to grow, as you can see, but compared to where we were in the past, it's not very significant. And it turns out that it's up 153% year over year, and we're more than halfway back to the pre-pandemic levels. But we're 90% less foreclosures than we saw at the peak in 2010. Institutional investor purchases of single-family rentals have slowed now as a result of what they see in terms of the market cooling, but they're still buying. And the value of homes owned by institutional investors has doubled over the past decade to $5 trillion, but they only own 5% of all single-family rentals. It's mostly mom and pops like you and me. And institutions plan on increasing the number of single-family rentals that they own in the next 8 years by eightfold. They plan on growing 8 times where they are now in order to get the benefit of cash flow. And that is going to be a challenge because it can only happen in one of 4 ways. And I won't get into all those ways now, but just know that it's very difficult. It's also important to note that price increases are driven by investor demand, and that's a concern, especially true for retail, mom and pop investors. In the first quarter, lenders originated over $5 billion in loans, which is 2.5 times the average over the last 4 years. That's in some way viewed as rampant speculation. And it's at a euphoric time in the market cycle. That tends to lead to a bubble. Well, fortunately, unlike the global financial crisis, these are mostly good loans prior to the March rate hikes. So they've got positive cash flow. And it seems that the speculation is on the decline. You see, when you're at or near the top of a market, whether you know it or not, you're more of a speculator than an investor. And when you're at or near the bottom, you're more of an investor than a speculator. Well, this shouldn't be news to you that we're at or near the top of a market. So speculation over the last 2 years has been significant. And as of early August, loans originated on income properties dropped 13%. Well, when price and interest rates increase as much as they have and as fast as they have, true investors, people who do research, people who know what's coming next, are likely thinking the cash flow and the appreciation ship may have already sailed, which is what I reported many months ago. 58% of flippers now say that some of their investments are no longer financially feasible. And as I've said before, when you're a flipper and interest rates are low, when supply is non-existent, when you list your property and have bidding wars over list, when annual appreciation is 10% or 20% or higher, you're benefiting from an unrealistic tailwind that you didn't create that forgives your mistakes. And that's what's been happening the last 2 years. And as a private lender, which is what most of our insiders are, we're making sure to know what we're doing and betting on experienced flippers. And private lending is doing very well because interest rates have gone up for private loans, points have gone up for private loans, so our yields have gone up considerably. All right. Flippers are now making much more conservative offers, and only 19% of flippers are willing to pay 70% or more of estimated ARV. That's down from 27% last quarter, and nearly half of flippers are unwilling to pay over 60% of after repair value. Why? Because we experienced too much growth the last 2 years. Just look at the correction needed to get back to the trend line. And oh, by the way, it seems to be underway. You see that new and resale home prices grew 67% per year until they slowed in 2019. Then they boomed at the beginning of, or in the summer of 2020, right after the pandemic. Single family rent grew typically 3 to 4% per year. And then all of a sudden the market flipped from oversupplied to undersupplied per our demographic analysis. And wages grew, but grew very slightly. So you can see that wages grew slightly, rents grew more, and appreciation was off the charts, but dropping considerably now. Okay, I went through that very quickly. In about 40 minutes, I covered, I don't know, 80 or 90 slides, but I did it quickly so that I could get to the point of today's webinar. And that is, what should you do about what you've learned today? What would I do if the roles were reversed? And that's what I'm going to share with you next. And then we're going to open it up for a little bit of Q&A. So what I would do if I were you, which is what we always do at any point in the market cycle, is make the economy your economy by winning the money game. I love volatility because volatility equals opportunity. And the more of it, the more compression there is in the wealth curriculum, as I call it, otherwise known as the money game, where I want you to generate more cash or income, accumulate more wealth, which are assets that both throw off income and go up in value, and keep as much of both as you can. How do you keep it? Well, A, don't lose it, and B, don't give it to the government. That's why you have a self-directed IRA. Well, you can generate cash through real estate in terms of cash flow or private lending. At the bottom of a market, we love real estate more because the market's going to give us lift. At the top of a market, we like private lending, but we do private lending at any point in the real estate market, whereas real estate, we get in, we get out, we profit, we move on. We accumulate wealth by scaling our private lending business or scaling our real estate business. But remember, real estate, in terms of accumulating wealth, is based on two things and two things only. It's never cash flow. That's not how you get wealthy in real estate. It's through appreciation and leverage. Well, how much appreciation do you think you're going to see in the next year? And how much leverage are you going to do? That is, loans you're going to take with interest rates climbing. So private lending is providing us what we need and investing in early stage technology, which is another topic. And then we leverage our Roth self-directed IRAs, and I live in Puerto Rico because my tax rates are between 0 and 4%. So living there, unlike this past weekend where Hurricane Fiona just kicked our butt, allows me to make double-digit passive recurring income regardless of my active income. I get to invest it. I get to keep it. I get to optimize my effort to return ratio and doing it all from a backpack. Well, the second thing you're going to do is, for attending today, you're going to just send me an email, or I should say complete a short form that I'll send you, and then I'll send you my free, what I call my Jerry Maguire epiphany, that literally put my life and my family's on a new, better trajectory called The Power of Six. There's no course to buy. There's no anything. It's just a free white paper that changed my life and allowed my sons and I to add zeros to our net worth. My youngest son went to Stanford, created now $2 billion companies as a result of this concept. And we have a group called Access Insiders, who are insiders to all the information that I share with you today that leverage the same concept. The third thing I'm going to do is invite you to take your choice of two of our upcoming fourth quarter 2023 webinars and live events. We just finished our virtual quarterly meeting, so that's behind us. We're going to reflect on 2022 and embark together as an insider community of already successful people who want to add a zero. I'm doing my final 3-day private lending workshop. We're going to be talking about our quality of life to optimize ourselves and our families. We're going to be talking about our investment fund. And this isn't a solicitation. This is just part of our insider calendar. We're then going to do a preview for our next live event, where we're going to be talking about amazing stuff with amazing speakers the early part of December. So anything in there, you get to choose two of if you'd like to participate. And we'll give you the details if you're interested, and we'll share more of this. But in order to do that, you've got to tell me you're interested. And if you're not interested, don't tell me. But if you are, um, go to Access Insiders. That's access with two C's and two S's, insiders, plural.com /new view. You will see my photo there. You'll scroll down, you'll fill out some basic information here. You'll complete questions. You'll click the button if you're serious, not just curious, and you'll be added to that community so you'll be informed. And then you'll get to select what it is that you'd like to participate in. And I promise you, any one of those will blow you away. But all of them together are powerful. And that's why we have a community of well over 100 insiders who are trying to get to where they're trying to go quicker through research, through investing, and through optimizing themselves and their family. So to summarize, make the economy your economy. Win the money game. Be on the inside, not on the outside. Go to accessinsiders.com /new view and do it now. Tell me about yourself a little bit, whatever you'd like to share. Hit submit, and I'll send you the bonus that I shared that changed my life. You can select two of our quarterly webinars or events that I'm doing in my fourth quarter on optimizing yourself and your family, on our Home Love investing fund. There's no solicitation, but you'll be able to see what a professional fund manager looks like and sounds like. You can go to my Just Be the Bank workshop on how to be a successful private lender to real estate investors and flippers. And you have a choice to go to our huge end of our year live meeting in Arizona, where I'm going to present 3 hours of our latest research, bring in a half dozen startup speakers, CEOs, fund managers, talk about year-end tax strategies and including investing in a Roth, set up our insiders to have an amazing 2023. That's what it's all about. So if you're currently an outsider and you'd like to be an insider and inform your decisions, it's either the end or the beginning, and you get to choose. I hope it's going to be the beginning of a relationship. And if you have gone to accessinsiders.com /new view in the past, it's been 1.5 years since I've done a webinar for the folks at New View. So you're likely no longer in our system, because if you haven't done anything, then we cleanse our system regularly. So make sure to do this, whether you've done it or not, and go to accessinsiders.com /new view and do it now before you forget, because the fourth quarter is beginning and that's where the benefit lies. So Brian, I'm done. I really moved through that quickly. So I'm going to turn it back to you. And if there are any questions, let's address them. And if not, we'll let everybody have a great weekend. Well, weekend. I should say a week and a weekend.
Thank you so much, Dave. I appreciate you taking the time to spend with us. I know you just had Hurricane Fiona flying through Puerto Rico. I hope everything's okay and everyone's doing well. But we're going to go ahead and open it up for Q&A. So everyone that has questions, go ahead and type those in the Q&A section. I will read them off as we go through. So I have a few questions myself for you, Dave.
Sure.
Where did your team gather this information? Are there specific resources that people should be paying attention to? Because there's just so many different conflicting ideas out there and different opinions, and no one really knows.
Yeah, well, I think we have a pretty good feel, because in 2005, when I spoke at Harvard, I said the market was going to implode, and it did. We all know that. And there were 2,000 people in the auditorium. And when I went back in 2008, I asked, how many of you followed my advice? And not one hand went up. And in 2008, I believed Las Vegas would be the #1 buy market in the US, and it became that. And in 2011, I felt the market was going to bottom in the next 12 months, and it did. The bottom line is, if you got this research, you can make better informed investment decisions, because there are cycles. The last 3 were in 79 and 80, in 89, 90, in 2007 through 2009, and we're now repeating another cycle. Is this going to be like the other ones? And your point was well taken. It's not going to be like them. And it's because there's so much conflicting stuff going on. On the one hand, unemployment is low, and it turns out that inflation is high. And it turns out there's so many things that are going on that I can't recap that I just did that lead us to have a macroeconomic climate now like we've never had during any other market cycle. So it is a mess. And that's why research now is more important than it's ever been, and why we spend 5 to 6 figures a month just trying to figure out what's coming next, because
Mhm.
we and our insiders have so much money in play, we can't afford to make mistakes. So, where do we get our resources and our data? I showed one slide that showed sort of all the different research sources we have. But people always ask me, well, how do I do this research? And I tell them, don't even start. Because it's, I mean, just imagine all of that. And this presentation was originally 365 slides that I culled down to 25% of that and flew through today just so we could meet the hour requirement. So that's a long-winded answer to your question. It's just not a simple time. And if you don't do this research yourself, you need to align with someone. And by the way, we're not selling research. It's just that we're sharing it with people to make better informed decisions.
Yeah, no, that's great information. And I do believe, people have to make their own opinions, but you can share your knowledge and expertise in the field and experience, and they can take it for what it is, and then they have to make their own decisions. We're not giving them financial advice, and same thing on the New View side. We're still giving them a vehicle that they can use to still make investments, and at least the burden of the high interest rates isn't as bad when they're using a tax deferred or tax free vehicle.
Absolutely. And again, I said this at some point in my presentation, but this isn't about, the sky is falling. Things are shifting. Uh,
Hmm.
are they going to shift as much as 2007 through 2009? I don't think so. But any shift is considerable when you think we've been on a double digit appreciation roller coaster over the last 2 years. And so we're going to see some correction now. And those that are better informed are going to be the winners, because
Yeah.
everyone else will sit on the sidelines out of fear and uncertainty. And I'm looking forward to the volatility, because that's always where the opportunity is. If you think about a market going up and down,
Hmm.
if you can time it properly at the top and the bottom, that's where all that wealth is accumulated. It's not off cash flow. Cash flow is the glue that holds these deals together long enough to
Hmm.
create a lifestyle and make some serious wealth. But that volatility, that appreciation or cap rate compression in commercial and industrial, and that leverage, that's where all that wealth is accumulated. And so there's going to be a buying opportunity for all of us here, and I'm excited.
Yeah, no, I agree. There's always opportunity somewhere. You might have to tweak a little bit of how you invested, 3 years ago to now. But that's why this is a great opportunity for people to evolve and learn and build their business and build their wealth in different ways that they didn't probably do before. But that's part of investing in real estate.
Yeah. Yeah. And I think, one of the keys to real estate investing, and you well know this, is knowledge.
Hmm.
If you're brand new to real estate, like we all have been at some point, it's a struggle because you don't know what you don't know. And that's the point of, being a part of what you guys do in terms of offering the opportunity for your clients to be able to be better educated. And, a year and a half ago, I was saying something different than what I'm saying today, because the market is shifting. It's not me. I'm not trying to force the market to do anything. I'm basically responding. My whole philosophy is it does not matter what happens in the economy. The only thing that matters is what happens in my economy and yours, because we can control the outcomes. You think about oil and gas and precious metals in the stock market, they've taken a beating. And
Yeah.
how much control do you have? None,
Mm-mm.
right? They just went down or they went up. But in real estate or private lending on real estate, you can literally control the outcome by underwriting the deal properly,
Hmm.
underwriting the loan properly, and doing it in a self-directed environment where now you can do it tax-free. It's like cheating, only legal. I'm a big fan of what you do. I know the reverse is true, and I'm grateful for you inviting me as you do.
Of course, it's always a pleasure having you, Dave. Well, I don't see any questions coming in, but that's all right. I think you just did such a great job of explaining everything and putting the puzzle pieces together for people to, figure it out for themselves. And they have great resources that you posted where they can find out more information, join some of your workshops. I think that's great. Thanks for the heads up on the conference. Maybe I'll pop in there and go visit.
Why not? Love to have you.
All right. Awesome. Okay, so we're going to go to wrap it up. This will be posted on our social media. So we post all of our recordings on our YouTube page. You can follow us on Facebook as well. That way you can always recap any recordings. If you want to reach out to Dave specifically, he provided his contact information. You can catch that in the recording. And if you have questions about self-directed IRAs, you want to have a one-on-one consultation, the best way to reach us is email us at iraspecialists@newviewtrust.com. That's IRA specialist plural at newviewtrust.com. All right, everyone, have a wonderful rest of your week, and we will catch up with you soon. Thanks again, Dave, for joining us.
And to you. Take